hope you had your afternoon coffee already and that you are ready for more insights from our panelists. So I'd like to welcome on stage our panelists. So Fiona Kinghorn, Madin Akpo Asambe, and Connor McKenna. All right, so I think we will dig into one of the most important questions today, increasing and complex one in venture. What does real value creation look like beyond just deploying capital? We could already hear that founders expect more and need more than just capital. And for investors, creating value often means stepping into roles such as mentors, operators, and connectors. So we'll talk about how does it look like in practice and how to do it well. But before we jump into the discussion, I'd like to provide more background information about our speakers. So again, Fiona is a CFO at B2Morrow Ventures with over 30 years of experience in scaling startups, IPOs, and M&As deals. And she brings rare mix of operational depth and corporate insights with a strong focus on inclusion and sustainability. Connor is a VP of Portfolio Management at Pronghorn, where he leads sourcing, diligence, and hands-on growth, supporting portfolio companies, while also helping build scalable blueprint for diversifying entire industries. And Madin, General Partner at Tacoma Ventures, also former growth stage operator. He brings a deeply founder-centric approach to value creation, grounded in data, KPIs, and authentic accountability. So really curious to find out what that means in a while. All right, by the way, all three panelists happen to be our valued clients at Westbury, so really great chance to hear your unique perspectives on this topic. I would like to encourage you to use Slido. So if any question comes to your mind during the session, please ask questions during the Slido. All right, so let's start grounding ourselves. Connor, you have mentioned during the prep that it all starts with strong relationships with founders. So how would you define a high-impact founder-VC relationship?
Yeah, Tustine, thanks for having us, first and foremost. So coming from Pronghorn, a little bit about our fund, because I think we're a little bit of a different model than traditional VC. We position ourselves as a hybrid incubator accelerator. We focus purely on beverage alcohol brands, specifically spirits, within the US. We are similar to, I say incubator because we do develop and launch our own brands in-house, which has benefits to our portfolio because we generate a lot of learnings from that experiences of having entrepreneurs in residence and seeing what it's like actually to be out there in the market on a day-to-day basis. And with every investment that we make, we also are performing what we call supercharging services. So it's our version of an accelerator. I'm sure everyone's very familiar with Y Combinator. You can Google us in 10 years and hopefully we got the same brand panache. But we have a bespoke consulting engagement. So we got our team here in the back right corner. A couple of our brands will be at the bar tonight, so hopefully you all get a chance to enjoy some of those. But while we have a small investment team, we have a team of subject matter experts behind us. So every time we invest in a company, we're doing a deep dive on what are the biggest opportunities and risks and pitfalls that founder may be looking at for the next 12 to 18 months, and what kind of strategies and recommendations can we map out for them to try and navigate that while maximizing the runway and accelerating the top line growth as efficiently as possible. That journey, most founders and probably most investors would agree, we have yet to see a pitch deck that says we will not be $1 billion valuation in 5 years, right? And it's always that linear, if not exponential growth curve. And a lot of part of our job is to help manage their expectations and build a trusting relationship along the way. So don't always go after that shiny new object. It's time to sometimes focus on building core capabilities or building core learnings inside your company. And I'd say what we've learned first and foremost throughout that journey is you have to meet founders where they are. Jerry in our back right corner has kicked off a process recently where we actually, on top of all the financial diligence that we do, I think this was actually mentioned earlier in the day as well, we're doing psychological profiles on our founders. And it may sound creepy and weird. I think that was my first impression as well. But understanding how a founder thinks and how the capability set of his overall team thinks, you can start to understand where are the gaps in their current capabilities and where they might most need the help for us to lean in and support. And we also take those ourselves and share them with them, right? So it's trying to create a balanced perspective of you may not know what you don't know. We may not know what's going to land resonate most strongly with you. So let's make sure that we're having open dialogue and really being clear on, perfect example, our supercharging activity one time, all these experts went to work on this brand, and it was top-tier people who focus on marketing and sales and supply chain and finance. And the end deliverable was a 120-page PowerPoint deck and a 6-hour-long presentation. And the founder's face at the end of it was just like dropped. Like I felt, and literally said, I felt like I just got handed the keys to a Maserati, but I don't have a driver's license, right? So value creation is not always just everything everywhere all at once. It is making sure you build out these sequence steps and communicating to the founder that confidently, I know there's a million things we can be focusing on right now, but this is the most important priority. Once we get this right, we can move on to the next thing and just keep laddering up.
Yeah, Martin, if you would like to comment on that.
Yeah, no, at the highest level. So I think value creation just in general and how we partner. First off, a little bit more on TVF. We invest in typically what we call the post-pre-seed. We're a generalist fund investing all the way through seed and Series A companies as well. Where we really like to dig our teeth in is when a company has actually gotten their first few customers, have some revenue in place. And as a generalist, the job that we bring is what we call an accountability layer, which I know was mentioned a little bit earlier, where we're talking to our founders and basically level setting that we are going to be the investor that's in the room with you, beside you, as you set your strategic plan for where you're going over the next year and how we ultimately report back not only on where we're doing in terms of attainment on those goals, but ultimately where shifts may need to come or go as things go. So that's the highest level, I think, of how we approach value creation just post-investment with our companies.
And maybe talking about some specific KPIs or OKRs with founders, how do you set up those?
Yeah, so following our intake, our diligence process is one that we kind of level set from the beginning is a little bit more involved. Given that a company will typically be in market already, really growing through their first customer phase, we like to understand from all of those customers what's working, what isn't, what are the key metrics that matter for this business's success. And then we break it up into a qualitative and quantitative lens of how we're going to be tracking growth for the company. So on the qualitative side, it's objectives and key results. So really saying in a 6-month cycle, what are the 3 to 5 key things, North Stars, that we're going to be tracking for attainment to kind of get to that next plateau as a business? And then ultimately, we kind of flesh out the key results, the things that support it across the team, and who within that owns those metrics as well. The KPIs follow the quantitative side. I mean, we're prescriptive on understanding revenue, cash burn, runway. But we also want to say, unique to this business, what are some of those metrics that can be those leading indicators of growth? And really talking about where it's working and where it isn't on a monthly, quarterly cadence for reporting.
And do you have these fixed or do you revisit it like over time? The KPIs, do you change them?
Yeah. So for KPIs, I mean, we're setting them on a strategic plan of basically a year. Really piecing out what is that like billion-dollar growth to where are you going to be as we look out to the end of 2026. It's meant to be fixed and meant to be from a bottoms-up view of what is the team here that's able to support this, what is attainable from customer acquisition. But ultimately, we're looking at those and ready to recast and set expectations on a 6-month basis, more or less, as we get to the end of each quarter with our portfolio companies. The biggest thing here, I think, by and large, is there are, in this kind of pre-seed and seed stage, there are a lot of founders that sometimes are fantastic and kind of have their process, can measure stuff, and we're really just working alongside them and what works best. But other times, those that have really just been sprinting at their product and putting one foot in front of the other, kind of chasing sometimes shiny things around the corner. This is really meant to say, let's pause, kind of make sure that we're all in alignment as a board, as a team, and also your direct reports to kind of see exactly what needs to happen and hold that accountability not only to themselves, but also to their investors and kind of people at the next stage of investment there forward.
And if you could say how to balance it without maybe doing micromanagement for those founders?
Yeah, so I think this is the biggest thing that we've even heard today. There's really expectation setting that happens pre-investment with our founders. So one thing that I sit down as we're going through diligence and they ask, what should we expect from partnership from you, which is a question that founders should always be asking. I kind of say in the world of hands-off investing and hands-on investing, we fall on the latter. We will be hands-on. That means that we are going to be there to pick up the phone, answer questions, run our network, but also there's this expectation that we will sit down for 1 hour once a month at a baseline and talk through where the business is going. That's kind of a two-way street. A founder needs to really want to buy into that process from our end, and we need to know coming into an investment that, as we set up a 10-year relationship with this company, it's not too much to ask for to really be in that co-pilot seat with them. The goal is never to micromanage, though. It's really fitting within their process, setting up those guardrails of reporting, but letting them run it and fit and see where it works within their business and processes as well.
Mm-hmm. Fiona, would you like to comment from corporate venture lens?
So let me give a bit of an introduction to BTV. BTV is the corporate venture capital arm of British American Tobacco. Our role is helping BAT transform away from combustible cigarettes into products that consumers can really enjoy and not do serious physical damage to themselves. So we play in CPG space, but also we play in very much in R&D, new sciences, new technologies. Our mandate is incredibly broad, which has benefits and it also has cons because we've got a small team, we're about 15 people, and we need to cover a very, very wide, broad space. The benefit that we've got is that we've got a corporate that's backing us and gives us money, so we don't have to go out and fundraise. The problem that we've got is we've got a corporate backing us. So the corporate says, we know better than you do. This is the company that we want to invest in because it's got some really cool stuff that we want to get our hands on. And we have to say, actually, we don't think that this is a sort of a proposition that offers a good enough return. So there's a constant sort of managing that constant tension. And then personally, from my perspective, is I've done 7 or 8 sort of startups myself. I'm a founder by instinct. And I ended up in this role just coming in to help do financial due diligence, ended up becoming a CFO. My job is very much mentoring our team to help them understand the founder's perspective and understanding, I mean, we were talking, Conor had a lovely example, and I'm going to steal it, but when they started, they gave, they sort of gave their startups a sort of, 250-page document that said, read all this and this will help you be a good founder. Founders don't have time to read. They are just firefighting the whole time. And our job is to help them understand where the priorities are, drive them into understanding that, yes, they might want to become a unicorn, but there are a number of little steps along the way to get there, and also to make sure that they manage their own expectations. I mean, my instinct with any founder is looking at their forecast is sort of halve the revenues, double the costs, and we may be getting to the sort of stages that we can think is an investable proposition.
And you talked about corporate being an advantage, yet a pitfall. So if you could elaborate on that, maybe how you manage expectations from internal stakeholders.
Yeah, and this is a very difficult thing because the corporate often sees us just as being a pipeline for M&A, and I think that's a real danger. We've got to not only be a pipeline for M&A, I think that is one of our roles, but our role is also to introduce new ideas to the business that are further down the track. The business typically looks at things that are relevant to the business for the next 2 years, where we are typically looking with a corporate VC, I think typically 7 to 10 years is our sort of time frame where we're looking to make clear returns and clear exits, and also to introduce, successfully embed those new ideas into the business.
Mm-hmm. Martin, you have worked inside startups through critical growth stages. So how does that operational experience shape how you support founders post-investment, especially in those early high leverage moments.
Yeah. So my background was that I worked at 2 later stage growth stage companies, scaling from the Series B to later stage Series D in the strategy and operations hat. And so strategic planning has kind of always been my calling card of thinking forward on where the business needs to get to in the next year or 3 years, bringing it down to what the next 12 months looks like, and then ultimately figuring out resources and coordination around the team to make sure that product can be supported by sales and implementations across the board. So I like to say to my founders, right, like, I know what good looks like when it comes to scaling and getting a lot of different coordination across the team going forward. At the same time, I ran a startup of my own and did the 0 to 1 journey and learning through all of the pain that comes in scaling from the beginning with a small team. And so I think that's the perspective that I'm able to bring in and how we run things. And ultimately, a strategy and operations hire, head of strategy, would not be a role that a seed stage company is looking for the first several years of operations. And so this is really bringing forward those benefits of principles first thinking, alignment around goals and attainment, much further along than ultimately it would come for a lot of these companies going forward.
Mm-hmm. And if you could maybe mention one area founders consistently underestimate after funding, what would it be?
Oh man, that's a great question. I think the highest level is there is always this sprint mode around we have a ton of things that we want to be doing. We just got money. There's like this new ChatGPT integration that we want to be doing over here. We're still selling our core product, but we want to be launching into potential international growth and a million things that come our way. And all of a sudden we're like, hold up. You're a team of 5 right now. What's realistic? What's attainable? And I think that's the biggest pitfall of just there are a lot of shiny objects out there. Just maniacal focus, I think, is where we see the most importance and need to really continue to keep our founders moving forward on where they need to go. Especially when things start to slow down potentially in their core business, there can be that quick, I got to be hopping here now, I have to be hopping here. Pivots are a part of this, but I think when there's that plan really set out and we're talking on that regular basis, the proactive communication, kind of strategic alignment around the board helps us be forward thinking on where we want to go, as opposed to like, hey, it's a storm coming right now and we're trying to last minute corral together everyone around the table for something.
Yeah, that makes sense.
Yeah.
Maybe talking more about concrete examples. Connor, if you could share a story where you shared a strategic partnership or placed a key executive, and what was the result of that situation?
Yeah, for sure. I mean, I'm finding myself smiling and nodding because I feel like there's only a handful of funds that invest in beverage alcohol, but the problems that all investors face are probably exactly the same, of just that focus. And I think when we first started out, I mean, a little bit about us, right? But I'd say our buzzwords are we provide capital, network, and know-how, and then we're smart money and we're active as all get out. And CPG brands take a very long time to build, especially spirit brands, right? It's a physical good that you have to move, you have to produce, bring to a warehouse, ship to a store, and then put in a consumer's hands. That is a very long journey, and there's a million things that can go wrong. In our universe, we're very early stage investors, so we're often seed, some Series A, but these are relationships that we want to be speaking with and realizing exits in like 8, 9, and 10 in our fund, right? There's not going to be those quick wins that I assume and hope many of the tech investors out there are able to have. But it's really hard. It's what was exciting for us at first. In our first year, we made 20 investments. We really stormed out the gate, and they were all small checks. But that created an operational problem for us because we're a team of 4 individuals and 20 very hungry mouths, all with very differing stages of development. We were like trying our damnedest to create a scalable playbook of like, all right, this month we're only going to talk about supply chain. But even within those 20 companies, you got some people who distilled their own spirits, some people who sourced their own spirits, some people who were impacted by tariffs, some people who were impacted by other supply chain constraints driven by the pandemic. And it was really difficult for us to do a scalable and repeatable model for our services side of things. So yeah, I find myself nodding along, and we had a great chat about this last night, about some of the parallels within our industry. For us and our founders, it has been really crucial to understand what is the I think I'm going to try and answer your question on two ways. There's a pro and a con to this, but one of our founders, we thought, did an amazing job of building a world-class product, right? This is like, think of a founder archetype of a mad scientist. This person bought their grandfather's sweet potato farm, built a distillery on site, and started making literally the country's best vodka out of sweet potato. And it was winning all the double gold awards in America. It was the talk of the town. But this founder had no concept behind how do I market this and how do I drive this to commercial sales. So a huge work stream was built around us of let's actually shoot a documentary. Let's hire a media crew, hire a film crew, get it bought by a media company, launch it in movie theaters around the country, and this will be a great way to market the brand. And it was an amazing opportunity for them to take that story, tell it on the national stage, and get attention from wholesalers and sales reps and different retailers in the world that could try and bring that product on. So that was an extreme example of value creation. A much easier example is the distributor that you're currently working with, your wholesaler, isn't really paying enough attention to you. So let's find the right wholesaler for you. Let's help negotiate that contract. Let's sit in the room with you. Let's get our pricing right. Let's get what accounts you want to be targeting based on who your consumer is and where they're most heavily concentrated and yada, yada, yada. This really deep data-driven process of support. And it was an example of how important focus is and how important those kind of sprint task force engines can really take a company from 1 to 2 very quickly. But then we had 19 companies saying, that looked great. When do we get our documentary? When do we get our wholesaler distribution? So for us, a huge part of just community building and overall managing expectations with our founders, we've identified as just crucial, right? Because it's almost it's the double-edged sword. If you're doing great for one company, now every other company wants the same thing. So how do you make sure you communicate to them what are those major milestones we're working towards? And if you are able to do this, this, and this, then you'll be in a position to unlock that next layer of value.
Mm-hmm. Thanks, great examples. Thanks for sharing. Maybe Medin or Fiona, would you like to share some examples of true?
So I was just smiling when you were talking about distribution problems. And one of our portfolio companies has just done an amazing job in building a D2C market, kind of absolutely perfect. And now they want to go into retail, and oh my God, is it a completely different world. They've suddenly got to talk to distributors, they've suddenly got to talk to outlets, they've suddenly got to be holding much more inventory than they thought they needed to do. And then you get into the world of things that they can plan and things that they can control. And they were importing aluminium from China, and the tariffs came down, and that just completely blew their cost model out of the water. And it's just helping them keep calm enough to say, okay, what are we going to fix immediately? What can we park? What can't we park? What do we do about this boat that's coming from China? You know, and just working with them to help them prioritize and to make sure that they got the product, enough product into the retail shops that we were wanting to take them in, to manage the store's expectations so that they knew there was going to be a delay while these ships were getting sorted out. And I think that's where we can really add a lot of value, is helping people keep calm and just sort of saying, okay, this is how we can help. These are the resources that we can help throw at you, but they are temporary resources, and don't rely on us always to do something like that. But we actually do have the muscle power to put in. We can really add value when there's a crisis.
And maybe a follow-up question. How do you know when they need help? Like, how do you...
They have to ask. We aren't part of the business. But that comes with building a relationship. Everything about this is people, people, people. Yes, I know, and I agree with the person who talked previously. It's data, 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 but it's people, people, people communicating the information. They've got to come to us and say, we've got a real problem. We can also anticipate some of that because, again, we know the business models, and we could see that one coming. But unless people sort of say, come in and can you do something for us, it's very difficult for us to pick up the phone and say, we think you're going to have a problem, and they're going to say, they're just too busy dealing with the fire.
Nadine, you have more data-oriented approach, so do you have like a story where you spot some KPI and you knew immediately that the company needs help?
Yeah, I mean, I think, we always have our pulse KPI-wise on both the leading indicators that we work through a business. So sometimes telling a story even where financials might be taking longer to pick up. We had a portfolio company that was really blowing it out of the water on assets generated for, usability and users on the platform. It was really a forcing function at first for the founder to be looking under the hood, but that helped us say, hey, there's a really strong narrative around here ahead of the next raise that maybe it's going to take time for revenues to follow and really pick up, but you can be telling what's being created organically with the company here. But that's at least on the KPI side. And I think on the OKRs front, which again, I really strike to draw that distinction between the measurable numbers but then the objectives, that helps so much just for alignment, understanding at that top level. And so much of what we kind of hold ourselves to is the ability to graduate our companies to the next round of funding. We're investing as generalists, and so one portfolio company, for instance, that comes to mind is BoldHue, that is effectively creating a Keurig for makeup. So you can scan your skin tone, put it into the device, and they'll print on-home skin tone foundation. I know nothing about beauty. It's hardware, it's devices, but I'm like, they are at the intersection of tech, inclusivity, driving forward a whole new category, right? And so when we sat down and established the OKRs for their business, we really said, okay, we need to go out to the next funders as well, all of the Series A players out there, and really understand what's going to be key for them to lead that next round. And so, of course, there were the obvious measurables of, hey, we need to sell out our first 10,000 units. That's easy to track. We're still figuring out who on the team is going to own the press release, marketing, all the lead up, what are the different blitzes that need to happen. But they also came back to us and said the importance of celebrity partnerships is going to matter a lot. Really having different distribution and manufacturing players will be key in this as well. And so it helps just give us a broader North Star set, but then also making sure that we have team members that are really coming into play at every step of the important areas that we need to get to across the business.
Great answer. Maybe if you could tell one thing VCs should stop doing in the name of value add, what would that be? And that would be a question for all of you.
Yeah.
I mean, Fiona and I were joking about this last night. I used to work for a CVC for AB InBev, and I think that the key lesson I learned there was just the hubris that can get involved in a venture capital mentality of, especially when you're a specialist in one industry, and we're guilty of this on a regular basis, but we can solve all problems, come hell or high water, give us a call, 24/7 phone line. And really recognizing that is even as smart as you are, there is no one magic beanstalk that you're going to be able to grow that everyone can climb. So I think for us it was really focusing on a few impactful levers and executing those with excellence versus doing 15 to 20 things with mediocre results. So yeah, I think that, and just being really clear with managing founder expectations that, yes, it's a 24/7 hotline, but if this is the fourth phone call I'm having on the same subject, then it's, this is I think David did a great job this morning. It's the teaching to fish versus constantly giving fish is a really core issue. And then the last analogy that we're starting to use more and more is our value creation of was a pull model. Founders had to raise their ass, but I think founders, we found a lot, it's a very solitary journey and existence. And without them, we wouldn't be here. And it's really hard sometimes for someone to raise their hand and say, I need help. So don't wait for them to say, I need help sometimes. Have those integral touch points, have that organic tissue, make sure whether it's a monthly call or your community events, or just raising awareness, seeing how they're thinking about certain things. create those opportunities so that the founder can safely say, I really need help here before it becomes too big of a problem to address.
So I think one of the comments that I wish VCs would stop doing, and this is particular to the UK and Europe rather than America, is there's a really bad habit of drip feeding in capital. So rather than giving a company enough money to get going, they say, okay, we're going to give you a little bit now, and you're going to have to hit this milestone, and then we give you a little bit more. And then, or you just say, here's a little bit, and let's see how you go. And that means that the founder is constantly in a fundraising mode rather than actually getting on and delivering. So I think that's something that I really don't like. The other thing that I don't like, but I think that we're starting to see a nice change, is much more collaboration. We should be working in partnership with other VCs. We want to work in partnership, and in fact, I think it's good for the industry.
No, I would completely agree, I think, on both fronts. And I guess one of the tropes that maybe sometimes I see, it ties to hubris. Again, maybe it's me sitting in the generalist forum, but when I am investing in a founder, I like to say I'm empowering you as the expert and owner of your field. The buck should stop with you. I'm here to help guide, give advice, give expertise, run around all to the different network people that we can help bring in your corner. But ultimately, we're going to be working in conjunction with you, really looking around corners and seeing what needs to come for the business going forward. And so I think when VCs come in a little bit heavy-handed, really kind of dictating, hey, I saw this portfolio company do this, you should be 100% focused on this area. It has to be a partnership more so, and a give and take with that founder, and continuing to cultivate that forward instead.
All right. Maybe talking about tech stack and tools that you use day to day, can you share examples of the tools you have in place? Maybe how do you leverage AI to make better decisions?
Yeah. So I'm happy to start. I mean, you kicked us off by saying we're all using Vesperi, so that's one of the things here. My fund has 25 million in assets under management. We're investing across 2 different funds, so we are incredibly scrappy with what we pay for and ultimately what we negotiate prices to and how we push things forward. But we're always looking for all sorts of tools to help us all throughout the cycle of discovery, evaluation, diligence, and then post-investment support. And so there have been platforms like, of course, Carta, PitchBook, Vesperi, all help and plug into that. I'm not afraid to build something in Google Sheets, even though that can be a curse word today, it sounds like, but help manage parts of the process through that. And then, of course, ChatGPT is becoming a co-pilot and helping us as we just do quick research, kind of get information on general areas, but then use it as a jumping point to really dive deeper in different areas as well. So that's it at a high level, but there's a million tools that we're always piloting and trying to figure out what comes in best, and then also thinking forward of where we want to grow the platform from its tech stack as well.
Yeah, I hesitate going after the AI speakers because I'm very JV level in my usage of it, but our company recently brought on Gemini. It's incredibly helpful for us. I think I'm becoming a better prompt engineer, but mostly just to help the thought process, especially when you have, just the day-to-day. You could be focusing on supply chain issues, sales issues, follow-on funding investments, new investments, negotiate. You can do all these different things. It's a really helpful centering tool. But it's also hilarious when you can tell some people start writing all of their emails using ChatGPT or Gemini, and you're just like, okay, this person got a master's degree overnight. And so that part I'm still trying to figure out. Vesperi has been honestly very helpful for us as a team, as well as our CRM. As I mentioned before, there's a whole team of people behind us, and we, as much as we would like to have one orchestrator for every founder in our portfolio that connects all the dots and is constantly quarterbacking, that can be an inefficient system, right? So if a founder strikes up a strong relationship with our marketing expert and they're in an ongoing work stream, it's really important that the founder is able to effectively have those or efficiently have those conversations. But we as the investment team need to know that those conversations are happening and they're contextualized within the focus of our fund. So Vestberry is our go-to resource of what are the top quartile brands that are performing well, where do we want to be focusing 80% of our time and attention, and then our CRM is our tool to be able to say, what are we actually doing to help these brands on a week-to-week, month-to-month basis. Incredibly helpful for us for when you're negotiating follow-on rounds, when you're negotiating why is the founder calling the marketing person when we told you should be focusing on your COGS right now. So those tools are just helpful for us. As much as communication with the founder is important, internal communication and alignment has become increasingly important for us.
Thank you, guys. Fiona, would you like to add?
So my background is sort of software startups, so I love technology and I love tools. And I drive my team mad because they insist on using Excel for everything, and then they hide it, and you can't find the right version of the right model. So it's absolutely imperative, I think, that VCs use tools and use them effectively, and that team carries on using the team. We love Vestberry because, well, I love Vestberry because it's a single source of truth. My team goes mad because I keep on saying, has Vestberry been updated? That's your first point where we update, and then we extract out of that. So it's just more tools, more AI, the better for me.
Thank you. Thanks, Fiona, and guys, for mentioning also Vestberry and the value it brings to your team. All right, I guess we have a few minutes for questions from the audience. So, Madin, this one is for you. It is important to plan and align shift, objectives, and KR. What is your strategy in forecasting and discovering, integrating trends plus evolution of technology?
Glad that's for you.
That's a complex one, so I'll give you time to read it again.
Technology. It's fascinating. So I think there is proactive work and there is reactive work that always needs to happen with all of our portfolio companies. And so when it comes to KPIs, OKRs, setting the strategy in place, that's meant to be the proactive view of what do we know needs to be true in order to move forward with where we need to be as that next plateau for the company. New technologies coming into place, forecasting the unknown, I think is where a company constantly needs to be ready to pivot, integrate, move faster, add new technologies at cost into their solution. And so it varies with each of our companies. I think that's the benefit of kind of having this plan. So it's meant to be changed as things come up like this. But I'll say, for instance, integrating trends and evolution, I think trends, for instance, could have been that we got sideswiped essentially by a lot of the tariff noise and reaction. And so with one of our portfolio companies, Boltu, for instance, that we were talking about, there was a lot that we had to pause for 2 months and kind of figure out what can we sell now? How do we quickly move to change distribution and manufacturing plants from China to Mexico, plus these other areas approach? That's not going to show up in the OKRs. But the benefit is that we could still be lining up exactly where we needed to be on some of the other key objectives, model out what a 2-month pause on some of these other areas could be, and then be looking down the line of what other strategies we could pull forward to kind of accelerate other areas of growth in the meantime.
All right. Any other questions?
I know that was at me, but...
If not, then thank you so much for your insights. All right, we have one question from the audience. Can maybe, Dave, can you please help me to the mic? Thanks, Connor.
Yes, thanks for mentioning that trend about the drip feeding issue. So for any of you, just to dive even further into this, so what do you exactly see as a mental block that keeps that habit persist? Like, what mental block would someone need to overcome with this? Because I've also, in that, and this has been many years, well over a decade, for many founders, they have deliberately been going on the low end of raises because that's what they're expecting to the point where they're probably not even raising close to enough to be able to actually get to a good run rate. So what do you see has to be overcome, at least in terms of one's mental block?
I just want to clarify, the mental block is coming from the founder or from the VC?
From the VC, yeah. So from VC, and then it spills over to the founder, as if that's what the founder expects, then they're going to raise very little, even though it's far from enough to get your next stage. Yeah.
I mean, it's a UK thing, but it's also more of it can also be a conservative investor approach in general. Sometimes we see in the Pacific Northwest, Seattle area, where I invest relative to Silicon Valley or New York even, raises are smaller, investors are kind of waiting for more traction metrics before they get to the next stage. I think the biggest thing is there's a lot of power that comes from your financial model as a founder. And so being able to say, this is where and again, I'm the data-driven guy, but like for me, if you're able to tell me where you need to be from a numbers perspective and the cost related to that, so from a bottom-up view of I need this team, I need to spend this much in marketing, that can really be building that journey with the investor early to say, great, this is the check that I need to put into this company, and also be working in syndicate with all the investors around me to get this founder where they need to be. And there's validation in this number isn't just coming from thin air because this is what other companies have raised. This is unique and bespoke to your company or a founder's company, which I think can get maybe investors over that mental block in the long term.
Yeah.
All right, thanks for the question, and thank you guys for all the insights and sharing your experience.
Awesome.